Hey there, Dale.
Hey, how you doing?
I'm doing well. I can't complain. Happy Wednesday.
Yeah, that's right. Happy Wednesday, not Tuesday. Why didn't we do this on Tuesday?
It's for good reason. The market had some news that we wanted to wait for. Specifically, the Federal Reserve was holding their meeting this month at the beginning of May. So we kind of wanted to wait for them and see where they're going to harass the market, so to speak. But before we get into that, let's go ahead. Dale, interest rates went up a little bit. 7.17 was the average for last week. For those of you that didn't watch last week's video, why are we not in the sixes anymore? What happened there?
Well, there's a lot of uncertainty in the market for sure. The Feds have taken the position. They've gone from 6 cuts to 3 cuts this year. And as of right now, no cuts this year. So I think that in and of itself speaks volumes that the Fed isn't really sure what they're doing. And that in and of itself creates instability in the market. And I think that's the biggest reason we've got rates trickling back up again.
Yeah. Now, this is a very reductive explanation. We've said it before, so I'll zoom through it. But federal funds are not in charge of mortgage-backed securities or mortgage interest rates directly. They influence, but they are not in charge of it. So a lot of what we see here is consumer sentiment and market sentiment. Is the outlook good? If the answer is no, your interest rate is higher. If the outlook is, really good and everyone's happy, and the answer is yeah, that's true, then we'll see lowering interest rates. The nice part about this is you can see this entire chart, all this fluctuation from, lower 6s all the way up to 8% like we've seen up here at the peak. Not one single Fed monetary policy changed any of this. The federal funds rate has been holding steady for this entire time, and you can see it's just based off of consumer sentiment.
So for those of you that are reading between the lines, the Fed has done nothing.
And we'll get into what they think they're going to be doing very shortly. But we have our credit education seminar coming up Tuesday, May 7th. The biggest reason for a good or a poor interest rate is going to be your credit. Yes, obviously, lower interest rates are great, but it doesn't matter if you have poor credit. Come on down, get some credit education. And if you know somebody that needs information like this, whether they're buying a house or not, send them our way.
Yep. And then the 21st of May, 5 o'clock at the office in Jackson, the first-time home buyer seminar. There is lots of good information for buyers here. Even if you're not a first-time home buyer, come down. Have them send your clients to just get informed about different programs and options that are out there.
Yeah, over the last 2 years, this has changed quite a significant amount in terms of benefits for first-time home buyers, programs for first-time home buyers, what the heck even is a first-time home buyer. So it's absolutely worth it. And as you just said, Dale, even if you're not a first-time home buyer, maybe you haven't owned a home in 3 years, technically you are a first-time home buyer again. So come on down. All right, let's get into it. We've alluded to it. Talk of the town. I'm just going to read this. Try not to be scared of this face. I made it somewhat small, but Janet Yellen said, in the near term, dealers expected the Fed to reduce the SOMA runoffs starting between May and July with a modal view of a June start. Most dealers expected the Treasury SOMA runoff cap to be reduced from $60 billion a month to $30 billion a month, while the mortgage-backed security caps would remain unchanged. Dale, that's a whole lot of gibberish. Can you simplify it for someone with a small, smooth brain like mine?
Well, first of all, there is no simplification of the Fed, okay? They just making it as hard as they can. So really what happened, one of the reasons that started rates on the upward trend is the Fed started selling off mortgage-backed securities. They call it running off the balance sheet. And now what they've done, I think, is they've realized, we can't be selling off so many assets because it's backfired. We're running rates up. So they're going to reduce that a little bit, basically about half. So they're not going to be selling off the assets as quickly as they were, which should help. In addition, as you pointed out, they're going to start working at other indices, other parts of the economy, hopefully as this all ties together, but they're not going to do anything with interest rates.
And more specifically, they're not going to be touching the federal funds rate. They're hoping this is going to be a very temporary Band-Aid fix where they can stop helping out other parts of the market, stop running off things. They do promise that they're going to leave mortgage-backed securities alone, which could be good news on the sense that if they're going to continue supporting mortgage-backed securities, they're not going to do these runoffs and reduce the spending that happens with mortgage-backed securities. We might not see a rise in mortgage interest rates, but again, they're not going to do anything with the federal funds rate, and they have had quite a double face when it comes to a lot of their policy. So right now we're floating.
Yeah.
We're just hoping things will either go down slightly or remain unchanged and people stop destroying the market.
Here's what scares me the most. We've gone from there's going to be 6 reductions that have not happened to 3 reductions, which has not happened. And now we're not even talking about reductions. We're talking about other things to manipulate the economy.
And here's the best part about that, Dale, what you said. They still haven't gone out and said officially that they're going to not do any reductions in 2024. Right. Now they're playing the game where they're just not even talking about it. Before they were kind of like, it's not the right time. Maybe we'll see March 2025. Maybe we'll see June or July of this year. But we're not going to give you the exact answer. Now they're pretending like the boogeyman doesn't even exist.
Yeah, it's kind of nerve-wracking, to be honest.
Yeah. So basically, what's next? What wraps up is you got to just keep going forward. Whether the market follows or not, goes the direction we want or not, it's most important to adapt and overcome in this market. So here at Homestead, we do just that. We have many strategies, many programs, and many plans to help you and your clients get into the homes of their dreams. If you have any questions or you need to run a scenario by us, absolutely give us a call, shoot us a text or an email, and we'd be more than glad to serve you.
Absolutely. Through all this Fed nonsense, prices on homes have not gone down. So, as we've said over and over and over, the time to buy is now.
Yep.
We can deal with the future when the future comes, but the time to buy is now.
Yep. And the simple case in point, prices keep going up, Dale, as you just said. Let's say interest rates do come down, great. Take advantage, refinance when the time comes in the future. Yep. And let's say interest rates don't come down. Let's say they remain constant or they even go up. Well, then you better be glad that you not only got the house at the price today, but you also got the interest rate at the price today. Both scenarios point towards now is the time to buy.
Yeah, I agree.
All right.
I agree.
That about wraps it up, Dale. Thank you so much.
Have a wonderful day.
You as well. Take care.
Okay. Bye now.